Hello and welcome to Cafe Mutual YouTube channel. Friends, equity funds have been touching new highs every now and then. In such a scenario, many of you may be finding it difficult to deploy incremental money, especially the lump sum flow. So to help us understand the future course of markets, today we have with us Dhimant Shah, Fund Manager ITI Mutual Fund. Dhimant has over 25 years of experience in management and equity research. So without wasting time, let's welcome Dhimant. Dhimant, a very good morning.
Yeah, hi. Thank you. Thank you for the invite, and really looking forward for the quick fire questions that you would be
Great,
having today.
great. Dhimant, as we know that equity markets largely remained flat last year with events of heightened volatility and all-time high numbers. In fact, most categories of equity funds have delivered not so good returns last year. So in such a scenario, why should MFDs continue to recommend equity funds to their clients?
Uh, uh, I mean, 1 year, in my opinion, does not change the broader picture, the brightness of the broader picture,
Mhm.
and anyway, the returns are subservient to a longer earnings trajectory rather than a 1 year scenario. Great. I mean, I can understand that, 1 year, if you dissect it from point to point,
Mhm.
quite a few funds have not beaten the benchmark. But
Mhm.
understand one thing that the in a in a in a vicious year where you have, not only overlaid with war, other geopolitical events, supply chains being out of whack, raw materials not available, logistics costs going haywire, and to some extent even talent not available, the correct talent at correct price, and so on and so forth. So when you have multiplicity of problems overlaid in a very vicious year, chances are that the active fund manager
Mhm.
would be sort of be underperforming, because it's
Mhm.
too much data to kind of have a standardized approach and finally boil it down to a decision making at the portfolio level. So there would be a lead lag, and possibly that's what has caught on the most of the diaspora.
Okay. So, Dhiman, there are a lot of concerns around valuation. So, how comfortable are you with the valuation with respect to the valuation of markets currently?
So I think there are a couple of things to prove this, that
Hmm.
even if you have invested over a longish period, 10, 15, 20 years, the probability of you making positive return is as close to 100%, even on the top end. So
Hmm.
you know every month, if you have done a SIP and invested at the the highest point in that particular month over a longish period, 8, 10 years, 9, 10 years, and more, I think despite that you have ended up making decent returns. The
Hmm.
point it proves is that investment needs fruition of time, overlaid with time, and also over a longish period, the second rule plays out is that the your wealth creation follows the trajectory of the earnings, underlying earnings. And
Hmm.
once you have kind of once these two equations catch up, I think so the outcome naturally is a reasonable wealth creation journey.
Great. So, Dhiman, what's your outlook on equity markets into 2023?
As things stand today, possibly I think it would be a a tale of two halves.
Hmm.
So pre-interval and post-interval,
Hmm.
meaning Jan to June would be the first half of the movie,
Hmm.
and July to December would be the second half of the movie.
Hmm.
The first half looks again reasonably vicious, as the trajectory of inflation in most of the developed markets is yet to come down, although there are signs that it might come down, but it has to come down with a reasonable surety. And it need not be tactical or short term, where you get excited over a very small period of time, but without dissecting actually the underlying of the so You have resets of even bilateral trades which will help. Energy is one more important facet. Supply chain resets are second facet, and kind of job creation and stability of growth is the third. Now clearly I think last 10 years, the global growth was 3 to 4%, give or take. The prognosis is that ensuing 10 years, this would be more like around virtually half that number, and so 1.5 to 2%. So clearly I think so somewhere IMF in its study is taking a lot of pain possibly ensuing. So we are hoping that the war would possibly settle, the supply disruptions are settling, the logistics are settling, and all of the upheavals that we witnessed last year would by and large settle in the first half, and possibly more of the countries would be amenable to kind of resetting their own growth parameters, and kind of be more approachable towards growth. And hence we feel that the second half possibly of this calendar year should be reasonably okay. And if this plays out to the T, then possibly we might have a slightly better year in than 22, because 22, your first month of February, or the second month of February, you were hit by a geopolitical event. Uh, Possibly and hopefully we may not see any repetition of on any front, although there could be still somebody like a China wanting to expand their borders and so on and so forth. So you'll have these skirmishes with Taiwan, with Japan, with even India, Burma, so on and so forth. But that said, I think so if you don't have a geopolitical upheaval apart from what you have already suffered by way of Ukraine and Russia, then I think so the outlook is reasonably okay.
Okay. So, Dhimant, how should MFDs deploy incremental inflows in equity funds? So, should they recommend lump sum in equity funds or continue doing STPs?
So the answer is not very straightforward. Ideally, SIP would be a reasonable, because any outplay of event today is not can be vicious, can be short term, can be medium term. So you don't really know. But so if you have kind of essentially laid a smoother path by way of SIP, then I think so it's really fruitful and helpful. And secondly, for people who rarely find time, have been busy with their vocations, profession, whatsoever, and they have lump sum to deploy. And if they can, to an extent, time it with the worst of the market, or in their opinion, where let's say a Nifty falls by 100, 200, 300 points, uh, maybe that day could be a great day to possibly deploy the lump sum. But by and large, I think the answer in this kind of environment would be more tilting towards the SIP.
Okay, great. So, Dhimant, ITI Mutual Fund has launched ITI Flexi Cap Fund. So, what is the rationale for launching this fund, and what makes ITI Flexi Cap Fund different from other Flexi Cap funds?
So each fund will have its own, uh, you know, men material resources. So
Hmm.
let me come to men. I think we feel that in any successful AMC, we need good people joining us who can you know not only help us identify new trends and new stocks and so on and so forth, but also stability of the team matters. So, and which we feel that after a small hiatus in the recent past, I think we are recuperating the entire team. The team, to our mind, will be good, solid, and sustainable. And once we have the basic ingredient, because this is a people's business, and once we have the basic ingredient, which is a good set of people on board, I think the outcome can only be reasonably strong. Why flexi cap now? Possibly this is by far the largest category now. It has overtaken even large cap category. So out of the the large cap category is at 2,42,000 crores, and the flexi cap is at 249. One can argue that why now, why not later, and all of that. So, but there will be uh, counter arguments and arguments at both the ends, and it can continue forever. There is no right time or wrong time per se. We feel that this is a big arena in which we need to have, and this also completes our overall size of offering in each bucket. So we have a small cap, we have a multi cap, we have a mid cap, we have a large cap, we have a value fund, we have a sectoral fund, and this was the only missing piece in a way. So I think this also completes our complete set of offerings vis-a-vis most of the other AMCs. So I think that was the rationale.
Hmm. So, Dhiman, can you take us through fund management philosophy of the fund, ITI FlexiCap Fund?
Uh, the fund philosophy is really simple, and this coinage or this acronym has been oft repeated. So, at the sake of repetition, I'll repeat it once more. It's identifying growth at a reasonable price. Now, if you take most of the from especially from the reforms process, post reforms process, our reforms process started in 91, 92, uh, early 91, 92, or 93, whatever. So we have seen almost 30 years. And this 30 years, if you compare it with any bucket of the previous years, has seen amongst the most solid wealth creation, in at least the Indian stock market history. So clearly, what changed? What change was, we graduated from being a small size economy to a decently sized manufacturing base, services base, and agri based. Even today, we are self sufficient and agri. Most of our services are doing reasonably okay. What we possibly lack is a little bit of more robust manufacturing, and which we feel that the PLI schemes should be able to kind of conjoin this piece as well. Once all the PLI, the already existing PLI and the likely to be proposed in the ensuing budget comes by, I think we feel that this can almost double the manufacturing base. And even if you assume a basic growth for the other two segments, which is services and agriculture, I think our manufacturing base, which is around 18% in the GDP, will grow to at least 25, 30% anywhere, depending on how the other growth also pans out. But the basic assumption being that we have a flawless execution of the PLI. And if so, then I think at a global level also, then India will have its right space, right ability to, contribute to the global growth, global exports, and all of that. When India started the reforms process, we were less than 1% of the global trade. Even today, we are less than 3.5% of the global trade. And look at our neighbor. Our neighbor China is around 22, 23% of the global trade. So clearly, I think so. If you, even if you have to be a reasonable number two, I think this conjoined piece was a big miss, and hopefully there should be a reasonably strong reset over next 2 3 years, 4 years, and once that happens, I think we will see a very very strong comeback.
Dhiman, flexi cap funds are in a way similar to ELSs and multi cap funds. So, what additional benefits can investors get by investing in flexi cap funds that are not possible with ELSs and multi cap funds?
So ELSS is 3 year lock-in, 80% compulsory, investment. Whereas in Flexi, it is only 65% plus minimum equity. Plus, you can have a construct which is you can choose anything from anything. So, meaning you can go if you are, let's say, 65% invested equity, you can put that entire basket in large cap or small cap or mid cap or any proportion ratio that you feel fit. And so there is a lot of flexibility. Number one. Number two, of course, you can argue that uh, uh, then what is the difference in with the multi cap? A multi cap has, the basic thing is that you have to have a fixed proportion, minimum 50% in mid and small. And so you have to have a 50-25-25 ratio maintained by and large all time. So that's the only thing that kind of weans away further flexibility. So at any given point in time you are exposed. But let's say where suddenly we have seen in the recent past also that suddenly with bouts of selling from FIs, the markets can get fairly illiquid. And if you are positioned only small cap, mid cap at 50%, maybe in flexi you possibly are wanting to elevate to a larger proportion of maybe mid and large, or a large and mid, or at least much lesser exposure to small, because suddenly it gets into a stage of illiquidity and so on and so forth. So these are the 2-3 factors that we feel that uh, the flexi cap does have some amount of edge in your ability to execute.
So, Dhimant, one last
Yeah.
question. Uh,
Yes, please.
there are a lot of flexi cap funds with good track record. So, why do you think that MFDs RIA should recommend this NFO to their clients?
So it's like asking why should you open one more hotel when there are thousands of hotels. So the curious answer to that is that we feel our overarching philosophy, the kind of people we are onboarding, and the processes and the risk parameters, all of these in a combined fashion will lead us to a reasonably strong output. So we need to understand that most of the successful or by and large successful AMCs have had a very reasonably strong subset of people who have been there for a longish period of time. And it's important to not only understand the people working with you, but also the processes and also the related risk parameters and all of that. Once all these are really really kind of enmeshed with each other very strongly, I think the meaningful outcome is only positive to our mind. So clearly I think we need these basic things very very you know uh, very very strongly ingrained. And why not us on why not yes, by construct right now at least we are a smaller fund, so the flexibility we think at least till we grow to a reasonable size. So let's say a flexi cap which is, let's say, 30-40,000 crores will have that much less flexibility because of its size. And we have seen in the recent past that, and rightly so, that about 78% of the monies have been deployed by all the flexi caps that are currently there in the market in the large cap, about 15% in the mid cap, and the balance is kind of put in small cap. So like I explained that the need of the hour is to conserve capital, and then also the second layer is producing more reasonable alpha. And sorry, the second layer is to beat your benchmark, and third layer is to kind of generate alpha and all of that. So I think once step 1, 2, 3 fall in place, I think the outcome can be reasonably good.
Okay.
So our endeavor in the recent past, we lost more than 50% of our manpower. So we are recuperating that team, and once we feel that that process of onboarding people should be over in 3 to 4 months, and once that is done, I think our ability to respond to many situations, many underlying sectors, so on and so forth, will be much more better than it has been in the recent past. So I think the only thought process, and last but not the least, both Rajesh, me, and some of our team members carry a reasonably strong, very strong experience in the market. So I think the team possibly will deliver, and that's the hope. Uh, yeah, that's the entire thought process. People can be tactical and switch from one fund to the other, and if somebody is giving you a 1/4% more brokerage and so on and so forth, you can be tactical throughout your life. But question is, uh, does somebody have a backup in terms of strong track record and all of? I think I had a reasonably strong track record. So does Rajesh, and so does some of our team members who are onboarded and likely to onboard. So I think sum total will be reasonably positive.
Great, great, great. So with that, we have come to an end to this interesting session. Thank you so much, Dhiman, for your valuable insights and time.
Thank you so much.